Hello.
Nice to have you here. Welcome.
Excellent. Thank you.
So this is the moderator for our next panel. Tell us a little bit about yourself, Andrew.
So my name is Andrew Dix. We are the publishers. I'm the publisher of Crowdfund Insider. That's the leading digital news site for all crowdfunding news and information, and also fintech. So we write a lot about the issues that have been discussed all today and yesterday, including the hot ICO market. So,
you got a lot of material here from this conference, huh?
Yeah, so there has been a lot of excellent material here.
Yeah.
I'm learning too, so I'm happy to see so many people here to learn about crowdfunding, ICOs, and all sorts of other forms of alternative finance.
Yeah, we're learning lots today. So, all right, let's get right to our next panel. Andrew will be here to introduce the next group. Thanks so much.
Yeah,
Enjoy the next panel, folks.
Thank you. All right. The panel that I have the honor and privilege to do is called Getting Your Corporate House in Order Before Crowdfunding. Now, this is kind of a block and tackle type subject. That's not super as exciting as doing a tokenized offer, but it's stuff you really have to do, and you've got to get it right, and you want to get it right the first time. And if you don't get it right the first time, you can blow your exemption, get in trouble with the feds, and have to pay a lot of money to attorneys and CPAs, something nobody ever likes to do anywhere. So, before I get started, I want to say a shout out to Alon and Yosef. I think they're back in the corner back there. There you guys are. Thank you so much for putting this together and for inviting me here again this year. You guys do a great event. This is fantastic. And I also want to thank all of you who are sticking around to hear about what you got to do to get a crowdfunding offer live. So I'm going to ask my panel participants to come up right now. You guys just come on up and grab a seat, and we'll get started. And these guys, they know their stuff. I just get to ask the questions, so I have the easy job. So we have David Gosselin from DBB McKinnon. That's a CPA firm. We have, I got to get the name, Craig Denlinger from Crowdfund CPA. We have Zahid Aziz. He's another CPA with Miller Ward and Company. Thank you. Raise your hands. Marty Tate. He's a partner at the Regional Corporate Finance and Securities Law Firm of Carmen Tate Lenhoff Israelson. I'll spit it out. Gotta put my glasses on. And then we have Jeffrey Marks. He's also corporate counsel. He's an attorney. And I'm going to ask each of you to kind of share who you are, what you're doing, give like a 2-minute infomercial. And we'll start down there with Zahid. So do we have enough microphones to go around?
Hi. My name is Zahid Aziz. I'm with Miller Ward and Company, CPAs. We are a traditional accounting firm providing accounting and tax services for our entrepreneurial clients. Most of our clients are closely held businesses. We act as the controller. We prepare business plans. We start from the very beginning where we help them choose the entity, the kind of entity they should be operating, putting the accounting systems together, spelling out accounting policies and procedures. At the end of the day, make sure that they are compliant with federal, state, and local laws as far as tax laws are concerned. And also, as being part of the team, we help them build a business plan, work on their projections, short and long-term projections, cash flow analysis, and make them ready to be funded or to apply for funding the various opportunities that's available out there. Thank you.
Hi, I'm Jeff Marks with Alliance Legal Partners. I am a small corporate law firm, ex-big firm lawyers, handle a lot of crowdfunding, finance, mergers and acquisitions, help companies get off the ground, and I'm also an entrepreneur as well, and done a lot in the crowdfunding space over the last 18 months, and serve as outside general counsel for our clients, which range from startups to middle market companies. And we have fun.
My name is Marty Tate. I am with a small regional corporate finance securities firm. I got involved with crowdfunding pre-Jobs Act, actually, I had a client that wanted to do peer-to-peer payday lending. So we, following the Prosper model, created started down this path of creating this a structure that would work for him, and then through that heard about this legislation that was going through, got involved in that process, have been involved with crowdfunding really since the passage of the Jobs Act. I help companies. Clients include everybody from issuers who are raising capital through one of the crowdfunding exemptions to platforms. I work with a number of the platforms and portals, worked with a number to get those groups licensed, and then work with, just regular businesses, everything from startups to public companies, and helping them raise capital and conduct their business.
My name is Craig.
Here's another one here.
My name is Craig Denlinger, Artesian CPA. Our website's crowdfundcpa.com. I started our firm 3 years ago, got involved in this industry a couple years before that. Really formed the company to service the needs for Reg CF and Reg A issuers, where the SEC put in requirements for financial statements to require CPA reviews or audits, depending on what you're doing. And so we jumped out and started working with that, and over the past 2 years and some change that this has all been up and operating, we've done lots and lots of these, got 100-some clients in between Reg A and Reg CF, have about 50 of them that have successfully closed funds, somewhere north of 50 million between our clients. And we kind of do some of the other startup accounting work for various other clients and ongoing help for the clients we helped get up and running that are successful. We follow them along for the ongoing and everything like that after the money's in.
So you're doing well. You've done a lot of these. Yeah.
Yep, busy.
That's a good thing, right?
My name's David Gosselin. I'm a partner at DBB McKinnon. We're a PCAOB registered CPA firm in Southern California based out of Newport Beach. We've historically done a lot of small cap public companies that are on the OTC who are here today and yesterday. The last 2 years we've done a lot of Reg A pluses and a lot of Reg CFs, about 65 combined. So one of the really great things for the people in the audience that they probably aren't even aware of is this panel has more regulation, crowdfunding, Reg A plus experience than probably any panel that you've seen over the last 2 days. And I know about 20% of all funds that have been raised through Reg CF have been one of our clients, and probably between Craig and I, probably about 50% of all funds have been one of our clients. So we've been in a ton of regulation crowdfunding campaigns as well as Reg A plus campaigns, and we get to see a lot of stuff.
So these guys are really experts in the space. So if you're looking to raise funding online in a crowdfunding offer, these are the guys. So we're very fortunate to have this group of professionals here. I want to get started by talking about the specific exemptions. I know several of the other panels have already talked about Reg A+, Reg D, 506C, Reg CF, and so I realize that some of the people here really kind of get that and understand it, but I think because we're so accustomed to talking amongst ourselves and getting into the jargon and the acronyms, I think it's better to revisit it very quickly. So I'm going to ask Marty very quickly to kind of give a high-level overview of the different exemptions. I really wish our regulators and policymakers had just created a single exemption and not confused the world with all these different regulations and acts and regulatory garbage, but that's how it works inside the Beltway. So share us, your information and knowledge.
Yeah, no, I appreciate that, and I agree. I can't tell you how many times people call me and they've got just numbers and letters floating around in their head and bouncing around. So basically the Jobs Act created, we're going to say 2 exemptions and then 1 expansion that we'll lump them all and call them crowdfunding. The first set of regulations that came out was called a 506C, which is a expansion of a Regulation D offering, which is just private placements. And what that did is a 506C is just they removed the ban on general solicitation, which meant for private offerings you couldn't advertise, you couldn't solicit. They removed that and said as long as you only allow accredited investors, which is high net worth individuals and entities. As long as you only allow accredited investors, then you can generally solicit, which means you can advertise, you can put it on a blimp, you can put it in the newspaper. 506C is a very useful exemption because there's no limitations on how much you can raise. There are no limitations on how much an investor can invest. There's really not a lot of limitations on what a issuer can say about the offering, as long as they're not being misleading or fraudulent. So that's the exemption that's used by a lot of the real estate platforms that have gone out initially. They were raising money for everything from equity to go into a building to debt and so forth. And there's been tremendous success with that. A lot of money's been raised. I don't have the latest numbers. I think the Next Gen guys actually talked about that, but that's been very successful. The next exemption is a Reg CF, or that's a lot of people think of that as truly crowdfunding. That allows accredited and non-accredited investors to invest. The amount that you can invest is limited based upon your income and net worth. It's a certain percentage of your income or net worth, up to a certain amount, and then with a Reg CF, issuers can only raise $1,070,000. It was $1 million initially, and they raised that. So it's a small exemption. It's really there to fill a space of friends and family, if you will. So it's smaller amounts up to $1 million or $1,070,000, and one of the things about that is you have to do that through a licensed funding portal or a broker dealer. So we've heard reference. There's Start Engine and WeFunder and dozens more that are doing those exemptions, and that has not garnered the same accelerated acceptance rate as the 506C, but I think it's still in its infancy. I think maybe somebody else can weigh in, but I think it's like 40 million that's been
Right, something like that, yeah.
Yeah, that's been done in about 16 months. So I don't think that's bad, and I think it will continue to grow and get acceptance as people start to more and more look to the internet as a way to invest and to take control of their capital. The last rule that or way that people raise capital through crowdfunding is, like I said, it's just an expansion of a registered offering, which is called Regulation A+. And that, unlike the other two that I mentioned, 506C and Reg CF, is not an exemption. It's actually a registered offering. So you're registering your securities. You have to be approved by the SEC. And that allows issuers to raise, I'll just talk about, there's two different tiers, a Tier 1 and Tier 2, but Tier 1 I think is a little useless because it's more difficult. You have to do state-by-state qualification, and I don't know, have any of you guys done a Tier 1? Yeah, so yeah, I don't think that happens. But Tier 2 allows you to raise up to $50 million. You need to have audited financials. That's kind of the catch, but you can raise it from accredited and non-accredited investors. There are limits on how much non-accredited investors can only invest up to $10,000. So there are some limitations there, but it's a mini public offering, and you're seeing a lot of traction in that. I've worked on several. I know Jeff's done a bunch. These guys have done a bunch. So I think that's a growing field where we'll see more and more capital raised. Did I miss anything?
So you think that Reg A Plus is kind of the standout of the three exemptions right now?
Yeah, I don't know. I don't know if there's a standout. I think it's just they're different things. And when a client calls and says, "Hey, I'm trying to raise. What should I do?" My first question is, "How much do you want to raise? Who are you going to raise it from, and how are you going to raise it?" And based upon that, we can kind of decide. If they say, "Hey, I've got this type of company, and we want to raise, $30 million, then very blessed.
Jeff,
Yeah.
did you want to add something?
Yeah, just a couple of things to add. You did a real good job, I think, explaining them. But with the Reg CF, which you can raise up to $1,070,000, that is just a filing with the SEC, and nobody reviews it. So you can file it. Once you file it, you can start selling. You want to make sure it's in compliance, and you disclose everything you're supposed to disclose. But once you file it, there's no review process, and you can start selling. With the Reg A plus, there's more of a comprehensive disclosure. You need to file with the SEC. The SEC needs to comment on it and finally approve and qualify the offering. So that's a longer process, and you actually need the SEC to kind of sign off on it before you actually start selling. One other difference is that with Reg A plus, with which you can raise up to $50 million, you can actually test the waters before you file anything with the SEC. You could put your offering out there and see what kind of response you get from investors before you spend all the money of preparing and filing with the SEC. You cannot do that with Reg CF. Under Reg CF, the rules are very strict. You can't even mention anything about an offering until you have filed your Regulation CF disclosure with the SEC.
Excellent. So thanks. So there you have it. I think it gets kind of confusing once you get into the weeds. These guys will be here later for questions and answers. So if you have any additional questions, please be certain to reach out to them. I want to jump over to Craig. We're going to talk about the financial stuff and what do you have to prepare in advance and on an ongoing basis with each of these individual exemptions, because it's, you know, the stuff you got to continue to do on an ongoing basis for much of this, but we'll let Craig explain.
I'll start with the easy one. The 506C offerings, you don't need to involve us necessarily. There's some exceptions to that, but pretty rare.
So you save a lot of money, of course.
Yeah. So that's kind of a new rendition of the old way. As for the kind of groundbreaking things where you can bring in the unaccredited investors, Reg CF and Reg A, they're very different animals for the CPA perspective, along with the legal. CF is a lot more toned down. We do what's called a review report, which is a lot less extensive work than an audit, which is required for Reg A. And there's other rules that apply to the Reg A ones that make it even more complex and difficult from the accounting perspective. But for either of them, your tax person or your monthly bookkeeper, whoever you have doing your accounting, it's not in the form that it needs to be for these offerings. It has to get converted to kind of the same format of financial statements for publicly traded companies you'd see, where you're recognizing a lot of non-cash transactions like stock options. If you issued those, we have to value those and book adjustments to show that as an expense. A lot of other things need to be moved around, and then everything on there. We're not just going to show that you have $100,000 of loans outstanding. We're going to turn that into a page-and-a-half essay about all the details of those loans. So it's a lot of work, and it takes a lot of time depending on how far in the company is, what they've gotten into, how complex transactions, the more complex the financing has been when we come in. It usually dictates how much work it's going to be. So it proves to be a big challenge, just moving from tax basis books to the full GAAP financials that we need to get to meet the SEC requirements. And so that's what firms like mine and David's do, is bridge that gap and get everyone up and ready to raise the money for these.
So what about ongoing? So Reg CF, which after 1 year was May of this year, everybody had to file something, and of course all the issuers forgot immediately. It was your fault though, right?
Yeah, of course it was going to be our. Yeah, no, David and I had many discussions this spring about predicting how many of our clients were going to miss that deadline, and it ended up being a tremendous amount.
90%?
It's something like that, yeah. And that was not because we weren't telling them and pushing them, and their lawyers weren't telling them and pushing them. I guess people got their money and thought they were done. But yes, so CF, you have to file an annual report due by April. Unaudited financials. Most of our clients still keep us involved because they have to end up in that same format I was just discussing, and without guys like us, it's hard to do that on your own. So that's the only real requirement for CF. So that's a lot easier on the ongoing side than A. With Regulation A, it's a scaled back version of a public company. So you're going to file at least twice a year. You're going to have an annual audit, which is burdensome. With an audit's a lot of work for us to, test everything that's ending up in those reports, and so we are, sticking with the clients and working with them to get these audits done in the spring and meet the deadline that is also due in April each year. And then in each September for a calendar year filer, they would be filing their June 30 financial statements with the SEC. And there's some other legal filings that need to be done for certain circumstances under Reg A. The moral of the story is Reg A is really an intensive endeavor. If you're looking at that, you really have to consider if you're sophisticated enough, if you have the resources, if you have the money to pay all the professionals you need to keep up with the ongoing. It's a much bigger burden than Reg CF.
Yeah, and there's actually one issuer who forgot and got in trouble.
Yeah, that was about a year ago.
That's a big deal because you don't mess with the feds, because they got big guns and you don't.
Yeah, so that was a particular issue. They were the first case in point. Their report that was due at the end of April, they hadn't filed it come September, I think it was last year, and the SEC brought the hammer down on them. And I think they surely with a lot of costs and a lot of hassle along the way, maybe 6 months later, I think they came to some halfway decent resolution. And I feel like there's a really big question mark out there of knowing how federal agencies work, and the SEC in particular. I can't imagine they're too pleased with the lack of compliance, particularly on the Reg CF clients, where I think it was somewhere in the neighborhood of 90% of filers didn't get their annual report in on time. As far as I know, there hasn't been any big sticks coming down on people for that yet, but I'm pretty confident to say there will be at some point.
Give it some time. But I think that the SEC is cognizant of the fact that, we can get to the questions afterwards, but I think the SEC is cognizant of the fact that this is very evolutionary. This is very early in the game, that people don't quite understand it, including some of the professionals. And you guys are experts, but there's a lot of people out there that say they understand this stuff, and they really don't. Attorneys and CPAs, I hear that complaint a lot. I don't know if you guys do. So I think they're a little bit hesitant to come out, with the big stick first. But you're right. Eventually, somebody's going to come down, and they're going to get slammed. It's almost inevitable. I'm going to jump over to Dave right now. If you could talk about some of the big challenges that you've experienced in putting these together, because you've done, how many of these have you done? How many CFs and how many A pluses?
I believe it's about 45 Reg CFs with a bunch more in the pipeline and 15 Reg A pluses that are filed. I think that's right around the right number.
Yeah, you're doing a good portion of them.
And a few more of those in the pipeline as well. So I think what Craig said is he hit it on the head. Is what's your level of sophistication, and that kind of dictates the complexities that we run into. And most of the time in the Reg CF world, we're dealing with very small companies, many times entrepreneurs that came out of bigger companies that have an idea and they want to start trying to exploit that idea and raise money. And Reg CF can really bridge the gap between VC financing or friends and family or bank loan. But these are generally very early stage companies, and the sophistication on the cap table and the transactions they're entering into makes things complex. So oftentimes we're reviewing ambiguous contracts where they're promising shares to people or percentages of the company or anti-dilution issues, and all those have accounting consequences. So most of the issues that we run into, as Craig mentioned, are non-cash related transactions. So anybody can, any bookkeeper, any general small business can link up their QuickBooks to their bank feed and get something fairly close to right on a cash basis. But it's when you start issuing stock options and warrants and commitments that are long-term, those kinds of things have accounting consequences that the average CPA firm doesn't actually know. In fact, there's probably only about 10% of the firms in this country do the kind of stuff that Craig and I do and actually have the knowledge base to do it. So when you're dealing with an unsophisticated investor or an entrepreneur that's trying to get into these complex things, it takes time for the professionals to figure out what are they actually doing and what are the consequences and how do we account for it and then disclose it. And in the Reg A plus side, there's a whole different set of SEC rules that have different accounting requirements. So I tell every Reg A plus issuer, if you have preferred stock, you should expect a comment from the SEC about your preferred stock and whether it's classified correctly. It's one of their #1 comments I see. And I know that's just strictly an SEC rule. So you have to make sure you have the right professionals and know to try to weed out these issues before you get your filing going.
Okay, well, that's great. Zahid, I don't want to ignore you back there, but you have an interesting perspective here because you work with a lot of small businesses, you work with a lot of entrepreneurs, and you also have been highly engaged with the SBA, correct? Yes. And so you understand that process too. So there are also alternatives to going the crowdfunding route, but maybe you could compare and contrast the two.
Sure. So I'll start on the top. What other alternatives are available out there in order to get your company funded or get the loans? Of course, we have the traditional way to go, which is the bank, which requires collateral and a good credit. But after that is an SBA, because SBA is guaranteeing most of the loan, or more than 50% of the loan. Banks will love to work with SBA, and the underwriting process is more relaxed. The guarantees are more relaxed, so there's more opportunity available. One of the highlight, or one of their main products are 504 and 607 loans. But apart from that, what we are talking about here for small funding, there's something called the Community Advantage Program, which SBA writes by itself through the community development organizations, and banks are not involved in underwriting those loans. The maximum amount of loan that you can get out of that is $250,000. First of all, bank is not underwriting it. The underwriting process is way linear. The terms of the loans are great. Lengthier, the time to repay the loan is extended based on your cash flow analysis. And also, since the banks are not involved, so it's easy process. The time frame in order to get it done is very short.
How long?
30 days, 45 days.
Okay.
And apart from that, there's another avenue available also, which is with the local government and state government. What they have done is they have created funds and made those funds available for small businesses. Amounts are not large. Their maximum amount is, I believe, 100,000, but they start from all the way from 25,000. Doesn't require any kind of a collateral, and basically good set of financials. If you have good records to submit, and those good records are financial statements, cash flow analysis, business plan, and business projections. If you can done them properly and submit with them, it's a pretty fast process, less than 30 days.
Just
if
as
you submit.
a quick question, do they require personal guarantees?
Not on the local government level, but SBA does require a personal guarantee, and that is sometime just to emphasize or kind of make a point that we are looking to get that money paid back. More of it is psychological than anything else. But yes, personal guarantees are required by SBA.
I was going to say that we've worked with quite a few hospitality-type companies that have gone through this process. One of the things I hear that sometimes they don't want to do is go through the SBA or a bank loan because they don't want to have to put the personal guarantees up. And one of the nice things about Reg CF is you can dictate the terms to a certain extent, which might not include a personal guarantee. But I've also seen it where, and I actually did look this up, and the client basically raised a couple $100,000, and they got a bank on board, and the bank said, well, if you raise the equity, we'll put up the debt for the construction loan. And they were able to actually use Reg CF and just get a couple $100,000 in equity to be able to do the construction with the debt
It's
loan.
kind of like security.
Yeah, yes. Nice combination of bank and Reg CF.
Yeah, so that's an option too. You can mix and match. So thank you for pointing that out. It's very important. I also want to mention that 36 states have interstate exemptions. So some states have laws that you can use within their boundaries to do a crowdfunded security. Now, talking about each of those exemptions during this panel is way beyond the time we would have here because, of course, every one of those exemptions is different, and some of them are good and some of them are not so good. But that is an option. So I actually have a list of them. If you're interested in it, you can grab me afterwards. But that's an option as well. Now I'm going to jump back to the kind of nuts and bolts stuff and go back to Jeff. So I call you up and I say, Jeff, dude, I want to raise money under Reg CF. What do I have to do? What's the first step?
The first step is to talk about whether Reg CF is right for your company.
Okay.
And there's a whole host of issues there that I think are probably beyond the scope of this. But from a housekeeping standpoint, the first thing you want to do is look at your corporate structure. A lot of companies come to me as limited liability companies, which is not the optimal structure if you've got 700 shareholders that are coming on board and you've got to send 700 K1s out every year. So corporate structure
Where's
is...
that line? Where do you kind of do the cutoff between an LLC and a C Corp? Is there a cutoff?
Well, a C Corp is usually better for companies that are bringing in a lot of investors in general.
Okay.
And LLCs I find are better for companies that are going to stay closely held or for real estate deals,
Okay.
where you need to distribution waterfalls and things like that. But so the first thing is looking at your corporate structure. A lot of companies might only have 10,000 shares authorized, which means that if they went into their current structure, they'd be selling shares at like $800 a share because, to get to the valuation. So the next issue is kind of backing into what number of shares need to be outstanding for your company, whether you need to do stock splits and things like that to back into a reasonable share price based on the valuation. And then, a lot of the issues are kind of planning issues. There's a lot of things that I see happen that people don't necessarily think about when they're planning their campaigns. For example, a lot of companies when doing Regulation CF offer perks to investors. And I see a lot of companies that will come with ambiguous perks, like we'll give you 50% off of all of our products. Now, guess what? You just set up a guy that can go and open up his own eBay store and buy your products for 50% off and undercut your sales. And so it's kind of little
Sounds
things
like a business
that.
plan.
You need like disclaimers and things like that. You also need to consider things like if your company looks like you might want to have some institutional financing or venture financing one day, you might want to consider putting buyback rights in. Because I don't know a lot of VCs that would want to come in and invest in a company that's got 800 shareholders. So you might want to build in a mechanism to buy out the shareholders at some valuation.
So that's a pitfall. You got to be aware that if you are looking to raise venture funding at a future date.
So it's something you got to think about. So the things you got to think about, you got to think about voting rights. If you create a second class of stock that's non-voting, so you don't have to give voting rights to the crowdfunding shareholders. There are little things like certificates. Most bylaws traditionally required that you issue share certificates. You want to make sure your bylaws are amended. You don't want to issue and track 700 share certificates if you do a crowdfunded offering. There's just a lot of little things like that that need to be considered that people often don't think about. And so it's really important to make sure that you've got a good lawyer on board, like Marty, and a good accountant to kind of guide you, because the mentality often is, well, we're going to save some money, but having somebody walk you through and prevent mistakes that will end up costing you 10 times the money that you're spending to do it right the first time.
Yeah. So what about that offering memorandum that I go on to the SEC and I download and read about the Reg CF offerings? Are you putting that together? Are they putting that together? Is it a combination of the two? Who's doing that document?
Well, I've only worked with two portals, WeFunder and Start Engine. And Start Engine has got basically a whole website that you access, and it guides you through filling in all the information, and it populates that offering circular, which then gets filed with the SEC. So you fill in the information, your attorney will go in or your accountant will fill in the accounting and the financial and the legal stuff, and then they automatically generate a Reg CF offering circular. WeFunder actually has that form kind of built into their site, I believe, and allows you to input it so it comes out looking like that form with your answers underneath each question. So it's different.
You review it.
What's that?
Then you would review it. You're the guy who says
Theoretically.
Somebody review.
Theoretically, some of the platforms encourage you to have a lawyer look at it, and I've actually heard that some of them encourage you not to have a lawyer look at it.
Okay, but you're not going to mention any names, right?
I won't mention any names.
All right. No, I think it's a good idea to have counsel look at these things. Trust me, you don't want to screw it up.
I have to say, I feel like I know what it's like to look at the eclipse without the sunglasses.
Yeah,
Finally.
well, maybe because somebody could bring you some sunglasses.
Well, and I would agree with what Jeff was saying and what you were saying, Andrew, about having a lawyer look at it. If for nothing else, a lot of times those programs or those sort of auto-populate formats, they're not designed for every industry. And so sometimes I'll be asked to review, and they basically just followed the form. And you have risk factors in there that don't apply. You have, real estate risk factors, and it's not a real estate deal. And even basic things like, because it's auto-populating the document, just sentence structure. Nobody's reviewing it, but there's things in there that you're like, well, that, because it auto-populated, it doesn't make any sense. So it's always wise to, even if you don't have your lawyer look at it, at least the issuer should review it and make sure
I would agree.
it reads.
How long does it take to do the whole Reg CF thing from your point of view, the legal point of view?
It really depends on how complex the company is. If it's a we see a lot of companies, and I work on a lot with Dave, that are really brand new companies. They've got no operating history, so there's inception financing statements, and then there's no insider transactions. There's no, there's your basic risk factors. There's no. MD&A. I mean, there's the MD&A is not complex because there's no operating history. So for those, it could range from 6 to 8 hours maybe to review everything.
I was going to say 30 to 40 minutes.
Don't give away my secrets now. But and then there's more complex companies. Like I'm doing a company now that's been in business for 15 years, and it's got 4 classes of preferred stock outstanding. It's got warrants, lots of insider transactions. So there's a lot of legal review that needs to be done, and a lot of, it's not boilerplate by any means. And so that's a lot more time.
Yeah. Marty, let's jump over to Reg A. I call you up and say, hey, I want to raise $50 million. Let's go. Let's do this now.
Yeah, it's a completely different animal. As Jeff mentioned earlier, the Form C that you file in connection with the Reg CF offering, although it needs to be correct and there is potential liability for material misstatements or omissions, it's not reviewed. There's no comments. The Form 1A that you file in connection with the Reg A Plus offering it's a document that's reviewed by the SEC. There's comments back and forth. It's a lot more intense in the amount of disclosure, a lot more time intensive to prepare. It's definitely not a 6 to 8 hours or a 30 to 40 minutes.
So I call you up and I say, okay, I want to do this. What are my marching orders? What do you tell me? Okay, you got to put this together. You need to do it now.
Yeah, so I actually have a questionnaire that that I'll send out, and I'll say, here, I need all of this information. It's a due diligence. It's basically answer all these questions. It's 15 pages long, and ask for, corporate documents, because it's intense. I mean, you really have to go through and understand everything about the company, and you need feedback from the company. The last thing that you want is your lawyer to be spending time and your dollars writing about your business, figuring out your marketing plan. And that happens where somebody's like, I don't know how we plan to market, or I don't understand what our market is. And you don't want to pay me or our firm to go and research what your market is. So we'll try to push that back to the issuer and say, get us this information, and then we'll create the Form 1A based upon that.
So are you guys, so you have to list all your risks, every potential risk to your company that you can think of, from, zombie apocalypse and on, right? So who's putting that together? Are you putting it together as a combination of the two?
So we'll put that together, but we'll definitely talk with the client about that, because every industry is different and every market's different. And so there has to be that intense understanding of that market, and I don't think, you don't want your lawyer trying to describe what, the risks are necessarily associated with your market. You're the experts in that field. We can help guide you. We'll, prepare language that we think is appropriate, but it's a cooperative effort for sure. And, I think, as may have been insinuated earlier, depending on the type of offering, if it's an operating company, then it's a little bit more straightforward. If you're doing, I know Jeff's worked on them, I've worked on them, if it's like a real estate offering or a REIT, it can be more intensive because you have just additional disclosures. You have prior performance tables you have to prepare about the sponsors of the deal. So that, again, it's labor intensive for sure.
So early stage, say it's an early to mid stage company that's raising under Reg A Plus. You got all the clean financials from these guys, right? They've given that to you. How long does it take to complete the first filing, and submit the first one? Weeks, months? Unknown?
Well, the answer is probably depends, but it's weeks to months. I would say a very well-prepared company, you can get, and you've got the financials in place, you can get filed within a month. I would say it's not, but again, that's if the company's very well prepared and there's a lot of cooperation back and forth, and your lawyer's responsive, I guess.
Jeff, did you have something you want to add?
Yeah, just one thing that I always thought was interesting and funny is the SEC puts the number of hours that it expects certain forms to be completed, and it's really quite funny because there's a semi-annual report you got to file as a Reg A company, which is literally just your MD&A section and your financial statements. So it's maybe a 5-hour job unless something significant, and the SEC tells you to budget 186 hours, of time to do that.
That's if they were doing it.
Yeah, the government, I guess, yeah.
Yeah, the government efficiency at its
I just
best.
find that very funny and interesting because it's so far off. It's not even close.
I think you should, straighten them out on that, Jim McCollum. Good luck with that. Yeah. Excellent. So in Reg D, if you're doing a Reg D.
So a Reg D, it's a private placement memorandum. Again, Reg D has been around for a long time. There's a lot of people who've raised capital using private placement memorandums. As Craig and David said earlier, you do not need to include financials on a 506C. But again, it's a lot of the same material that you're going to find in a. It's somewhere, I think, in between a Form C and a 1A for a regulation play.
It's pretty simple.
It's your risk factors. It's a description of your business. It's a listing of the officers and directors, the people involved. It's a cap table. It's financial statements, projections. Again, it's not regulated to the degree that a 1A would be.
One thing a lot of people don't know, though, is if you're going to accredited investors, you technically just need to provide them with a subscription document. There really is nothing else you need to provide them. I haven't done a full-blown private placement memorandum in years. And most of the ones I do are just subscription instructions with risk. I always like to do risk factors and put in all the disclaimers, the investor disclaimers. But most people are going with Reg Ds to people that they know and people that aren't going to read the documents anyway, and they're just going to write a check. So there's generally no need to pay a law firm $50,000 to prepare a full-blown private placement memorandum.
Yeah, and I would add to that kind of and maybe Jeff will agree or disagree, but it's a sliding scale. I tell people if you're raising the smaller amount of money from smaller number of investors, again, if there are people within your network, they're accredited investors, you know them, I agree 100%. It's a subscription agreement with some risk factors. If you're going out and trying to raise money like a 506C and you're trying to raise $25 million and you might have 100 investors, it's CYA. It's an insurance policy. These are people that you don't know, and it makes sense to try to describe. So you can point back and say, well, we did talk about that. That's kind of a rule of thumb that I agree.
Yeah. So, all right, we're going to switch a little bit here. We're going to start valuations. Valuation is really a hard thing to do because when you have an early stage company with little operating history, more of an idea, how do you assign a value to it? And this is something that I have a bone to pick with some of these offerings that I look at online because I look at this and I'm like, well, you're valuing this at $100 million and it's just an idea. And I think that's a little bit outlandish, but we're going to start with you, Dave, and say, what are your thoughts on valuing a firm?
The hardest part about valuation is when we work with companies as independent CPAs, we cannot give them advice on what they're going to be valued at. But being in the industry, we see the same things where you see companies coming out that are very early stage with very high valuations. And I think it's important to know what is a valuation. It really is just what a willing buyer and a willing seller are able to transact at. So sometimes it's in the eye of the beholder, right? And I do have a lot of issues with the Reg CF issuers and what their company is worth. Well, they might go out and say my valuation is $3 million or $2.5 million, which is a pretty standard valuation in the startup community if you're up in LA or Silicon Valley. But I also tell them, well, what is your company worth? Do you have any IP? Do you have anything that makes you so unique that someone can't replicate it? And if you guys ever watch Start Engine, which I'm sure all of you guys do if you're here, you'll notice when someone goes into the Shark Tank and they says, I'm worth $10 million, and someone like Kevin O'Leary will get up there and say, if you give me $500,000, I could pay someone to recreate what you did and basically crush you like a cockroach, right? So oftentimes I have to have that conversation with issuers and say, is there anything that makes you unique, or can someone just replicate this with a little bit of time and money? And if they can do that, then you have to be very careful about setting a high valuation, because you also have to think about the future. And what is your next round of financing going to be, and the one after that, and the one after that, and how many do you need to become profitable where you no longer need financing? If you price it so high that the next round has to be even higher, then you might not find investors willing to take that, and therefore you've kind of priced yourself out. So you have to be very careful.
Yeah, you got to be careful of the down round, and it happens a lot, and it happens with big companies. You see with big companies, they don't like to talk about it a lot, but you hear about it a lot. I don't know if, does anybody else want to jump into the science or art of valuation? Anybody want to share? Is this a sign? No? You guys don't want to get into it? It's really hard. I mean, it's hard to value an idea in an early stage firm. That's just a simple fact. I think it's important that you value it at something that you think is equitable, but also where you can raise the money you want to raise. If your valuation is too high and nobody backs you, well, that's a failure. And then you've wasted all this time and money trying to raise money to begin with that just didn't work, right?
Yeah, and one thing I do know is that if you want to go to a VC, if you want to go to private equity, if you want to get big investors, there is nothing that looks worse on your record than a failed raise. They just look very much down upon it. It's better to have a very successful raise at a lower valuation and make everything look like roses to these people than a failed raise.
Success breeds success. Is it working now?
Yeah, but I think that, in my view, that could be one of the downfalls or one of the problems that we see in the future, because, to be honest, most unsophisticated investors don't understand the valuations. And companies are setting such high valuations that most of these deals, investors are never going to see their money come out. And I think that, a few years down the road, if that continues, the regulators are going to look at that, and there might be some changes to these laws.
For the bad way, in a bad way. We'd
In a
like to
bad
see
way,
them
that's
improve
right.
to make it easier, but there's also the risk that the wheels fall off and the regulators or policymakers or politicians, and these are people that do not necessarily have any idea what they're talking about, will get involved. So we have to be cautious of that. That's right.
Exactly.
And that's one of the things I agree with Jeff, that in all of these, the company's setting the valuation. So an investor, needs to, unless the investor can sort of look at that and say, I don't think this company's at that valuation. A lot of times people are investing like, hey, this is a great idea, I like it, but they're not looking at that valuation and saying, well, what am I getting? I mean, I think they're pretty arbitrary, so that's a tough thing.
Yeah, so let's jump to the security structure, because when you raise money online, you have to sell them something. You have to sell stock, you have to sell debt, a convertible, or a safe. I think many of them are doing equity in safes. That's the bulk of them. But none of you guys, who wants to explain what a safe is to me really quickly? I know none of you guys like it, but there are some people who do like it.
I'll take a shot. A safe is a simple agreement for future equity. It came out of Y Combinator, I believe, like 5 years ago, roughly. And it's really an investor puts a deposit down on a future preferred round, generally, that may or may not happen. So you're really making a bet, or it's considered a derivative, that a company will need more money, they will raise it through a preferred, and it will be at a valuation that is beneficial to you. Is there
Deposit, important word before that, non-refundable.
Non-refundable deposit. And I'm actually one of the lucky or unlucky ones. I had the first company to ever file the SEC with a material safe on their balance sheet, and they went all the way up to the office of the chief accountant to determine if it was equity or debt, because many people in Silicon Valley will tell you it's equity, but the SEC will tell you it is debt.
At least the time you were talking to.
Or at least it's an obligation. Whether you want to call it debt or not, it's an obligation.
And it gets sold, you know, Silicon Valley loved it. There was the group that really loved it because, and they would sell it to the issuers as, hey, you're not, you know, we're not showing up on your cap table. It's not showing up on your balance sheet. It's just this kind of contractual right out there. I mean, I from an investor standpoint, I would be really leery of it just because it's a contractual right that to receive stock in the future that's contingent upon something that's uncertain.
It's important to note if a company is successful and never needs to raise a preferred round, the investor never could get nothing at all.
And this all jumps back to the valuation question. The reason things like that exist, and convertible notes are probably the most popular form of startup capitalization when they're going out to raise funds, and a lot of our Reg CF clients are using those. And the reason safes and convertible notes are used is so they don't have to determine that valuation. You can structure those to say, well, we're just going to give you a discount on the future, and so that's your incentive to invest now, or put a valuation cap on a convertible note so you don't have to know exactly what the number is, but you can say it's somewhere south of this. So I think I'm comfortable putting my money into this, knowing that that's the cap I can convert at in the future. So that's kind of the considerations that companies need to go through when they're determining what kind of instrument to use. There's equity, preferred stock, safe agreements, convertible notes, and all kinds of different renditions and different terms that can be applied to all of those to give different investor protections. One of the advantages of Reg CF and Reg A is that the issuer gets to at least have some strong input into what you're going to use there and what the terms are going to be, where before all this existed, that was in the VC world, you didn't have any say in that. You were dictated what the terms are, and
Jeff,
take the money or leave it.
Yeah, in my opinion, convertible notes are great in the VC world, and when you're dealing with sophisticated investors who don't want the valuation set and want to be able to speculate and earn interest. But in my opinion, in crowdfunding, you don't really. The fact that you're offering a convertible note, I don't think is going to make an investor. The investors are going to invest if they like the idea, and I'm not sure they're going to be swayed to invest in a company because it's a convertible note. And so my opinion is why have debt on your balance sheet accruing interest and have something that's going to mature one day when you don't need to?
Okay, all right. We're running out of time here. How much does this all cost? Does anybody want to share how much this costs? Zahid, how much? Give me a range of your expectations.
Most of my practice is closely held businesses or the early startups. My partners have taken deals in the past where they have invested in those startups, but I would say, you know, it's hard to put a dollar amount there, but I would say the beginners between six to 8,000 to set everything up to make sure that they're compliant with with the tax laws, and also putting proper accounting system in place to get them ready before these guys come over, as far as the legal counsel or auditors to come over and do their job as far as filings and doing the certified reports.
Reg A Plus is way more expensive, and I've heard a huge range. Does anybody want to share a range that they're seeing out there?
Yeah, like low end 30,000, and then high end. I mean, I've heard of some larger firms doing them in the mid 200s.
Yeah,
but
pick a number.
Smaller firms, I think is probably 30 for a clean company to maybe 100.
Yeah, and I could tell you on the audit side, I've had companies that are 10,000. I've had companies upwards of 100,000. It's just a matter of how big the company is, how many operations do you have, how decentralized are you. There's so many factors, which is always why we don't generally quote anybody as a standard. It's always a very custom quote to what we think it will be.
Yeah, and so this is kind of nuts and bolts stuff for accounting and legal. We haven't even got into the marketing and the actual selling of the securities, because as we all know, securities don't sell themselves. You have to go out there and push it and sell it. And so that's a lot of work. I think everybody here would agree that it's not Field of Dreams. You don't get out there and list it, and everybody just money rains down on you, it doesn't happen. Very quickly, does anybody want to share an anecdotal experience with, wheels fall off, deal gone bad, something really crazy that you've encountered, true life adventure, without mentioning any names and platforms? Anybody? Yeah, go ahead, Jeff.
Yeah, I had a client come to me that was referred to me. He was about to launch on one of the platforms, and he was an LLC. He didn't want to. They didn't want to change to a C corp, and they just didn't want to listen to counsel, and so they ended up filing, and despite my advice, and they had a limited liability company in a certain state, which under which a member-managed limited liability company is managed by all of the members. Every member gets an equal say in the management of the company. And they refused to change their operating agreement filed, and as a result, they cannot do, technically under the law, they can't do anything without unanimous consent of their 600 members.
Oops.
They can't even amend their operating agreement. And so that's kind of a big one.
Yeah, time to file bankruptcy and move on, huh?
Yeah.
So anybody else want to share a true life adventure? Come on.
I have two. I once created a fight between two co-founders because they didn't understand the difference between giving money to the company as kind of contributed capital and wanting that one founder was just contributing, one wanted his money back. And it became a big issue because honestly, they never had that conversation before they had to file financial statements. And I said, well, do you want to be paid back or not? And one said yes, and the other said no. And that was a big fight. And luckily, I think they ended up resolving and raised some money. But I had one issuer that was had a great email list, just a phenomenal email list, probably hundreds of thousands long in size. And I thought they were a surefire Reg A plus to make it. But they had such a poor, it wasn't the marketing message, it was the inconsistent communications with their potential investors. We're going to be at this broker dealer. We're going to be at this broker dealer. No, we're going to do this portal. No, now we're not going to do Reg A. We're going to do Reg CF. Now we're going to go back to Reg A. And it's a company that had the huge opportunity to succeed and probably failed because of the inconsistent marketing, not marketing, but inconsistent message they were sending their potential investors. So you do want to be very consistent and concise with your audience and come through for them.
Just to add to that real quickly, the biggest misconception that I get about crowdfunding is that I'm going to file on my portal and investors will come, which is the biggest misconception there is out there. You've got to market and get people to, you got to market.
And I would add to that, you budget for marketing and get somebody on board that can help you with that. I did a Reg A Plus for a company, great company, same thing, they had lots of customers, it's a retail company. They said, we're gonna market to our customers. They love us, they buy our product. So they did that, which is great, but they're not marketers and they couldn't message. So although they did generate some interest from their customer base, it was just the founders sending out goofy emails and they kept sending, well, is it okay if we say this, and is it okay if we say that? And I found myself saying, well, legally you can say that, but it's just not going to really do anything.
Don't do it.
Yeah. So
ICOs have been a hot topic. How many of you guys are working on ICOs right now, or have them in the queue, or looking at getting into them?
So I have several clients that are. Are in that process. I've worked on a couple pre-ICOs. There was some panelists that were up here yesterday. They're clients of mine. We've had discussions amongst ourselves about
Try to stay away.
Yeah, about what we think of them, and it's an interesting field. I'm a securities lawyer. I'm going to push it to be dealt with like a securities because that's the safest route. But that's my take.
It's still very much an evolving space.
Yep.
You guys will figure it out eventually. Did you want to add something, Jeff? Or you good?
Yeah, we're actually looking at doing a coin offering under Reg A Plus as a security.
Which would be the first, right? Maybe?
Maybe.
Yeah, I think it could be the first. All right, I think we're out of time here. Do we have any questions from the audience? Does anybody want to ask a question? I know you, yes.
How much does 506C cost average and the Reg CF average?
So the question is, how much does a 506C cost on average?
Compliance parts with the professionals.
With compliance and all professionals, Same question for Reg CF. Who wants to tackle that?
CF, I would say somewhere between 10 to 15 plus marketing, with marketing, of course, being a very, very important, highly variable cost.
You can spend a lot of money on marketing. You can spend, I've seen hundreds of thousands of dollars for Reg A's.
Yeah, it could be a lot. It's just whatever the company feels comfortable with. But I always tell people, think about it this way: you're marketing to raise money, but you're also marketing for your company. So there's a dual effect to it. And if you want to grow, you're going to have to market at some point.
That's something I wanted to say earlier too. Is for success stories in this industry, that was a big talking point. I've been doing these conferences for years, and that's before it came to fruition. Everyone was talking about the marketing advantage of once you bring in all these shareholders, you got 1,000 new people that won't shut up about you because they're now financially vested in you. And I've had a number of clients that after successful raises have told me the same, that they saw organic revenue growth coming out of having this network out there, and probably just exactly that, of having just done a big marketing campaign and really got their brand out there.
Yeah, so there's pros and cons to that. There's also the subject we didn't get to is managing your shareholders after a raise. That's another ongoing thing that you need to plan for up front. Are there any other questions in the audience? We got one
A
right here.
506C, I would just say it really depends. Like Jeff said, if it's a small group, you're using just a 506C, you're really just going regulation D, and it's a small group. You don't need to prepare a full private placement memorandum. It's going to be, I don't know, a few $1,000s, $5,000. Whereas if you're preparing a full private placement memorandum, that could be, 15, 25. Large firm prepares it, it could be 50.
All right, we got a question right over here.
Hi, thank you. I spent 17 years in the Reg A space doing creating all the marketing materials. So we would do the video, the website, the marketing memorandum, all the offering materials. The rule of thumb that we usually have is 10% of the raise went into marketing materials. I've never heard of it before, but that's how we got paid, 10% of the raise.
Okay, I don't know if everybody heard that, but this lady here, she was saying that she used to be in the traditional securities space for doing raising capital, and they would charge approximately 10% of the actual raise. Is there any other questions? Did I see another hand? There's one right here.
Since you're actually executing the Reg A Plus on the ICO, is that actually, are you rating it at the same rate that you would rate a typical Reg A Plus?
Rating it, you mean?
Like price, how much you're charging your client?
It's going to be a lot more expensive because it's breaking ground, and I'm sure there's going to be a lot more back and forth with the SEC.
So he was asking about the price to do a Reg A Plus for ICO.
Right, I'm saying it's going to be more expensive probably
Okay.
because it's new ground.
Thank you.
Question right here.
Yeah, continuing on that, if you're going to conduct the ICO under the regulatory framework of Reg A, what's the benefit at that point of doing that as a token offering? It's not getting you around the regulatory overhead.
Well, there's not much other than the publicity and the PR that would come out of it. This particular client also wants to get these tokens out for distribution. I can't go into much, but I can't go into much detail about it. But yes, that's a very good point. What is the benefit? I'm not quite sure.
Yeah, and I'm working on some similar offerings, and I don't know if there is a benefit other than, like you said, there's a buzz about it, but it's going to be treated as, it's really like a debt offering if you go out as a security. I know that I had somebody today come up and say, okay, so what if it's not a security? What if there's utility within the token and it functions within its ecosystem and isn't viewed as a security under the Howey test? Well then, what would that cost? And that's, really the lawyers, that's light touch because it's not a security. And but my advice, and I think Jeff would agree, is you're treading on really thin ice. I think the regulators, and this is completely being cynical, but if there's an area that the SEC that's kind of going under the radar, and it'll only be a matter of time before the SEC says we've got to regulate this. If for nothing else, it's potential income for them. That's really bad, but yeah. So I will push anybody. I'll push it towards being a security, as much as possible, unless we can really have a strong argument that it's not.
I think that's it. Can we give a big round of applause to our panel, please? Thank you very much.